Michael Burry is officially back. I haven't talked about him in a long time. I initially got popular on YouTube for analyzing his GEO investment. Some of you guys might remember me from the 21, 22 days, and I explained how GEO was trading below liquidation value. And it was a very successful investment back then. It still is, by the way. It's very, very cheap right now. But now Michael Burry is very excited about four new stocks: Lululemon, Molina Healthcare, Shift4 Payments, and another mortgage stock, if I'm not mistaken. So I'm gonna analyze two of them in today's video, and I'm gonna try to keep it short. So I really hope you enjoy it as always. The first one is Lululemon, and I'm not gonna spend a lot of time on this one. It's down 50% over the last 5 years. It's even down like 43% over the last 6 months alone. Lululemon is suffering from the worst thing that any, you could say, growth company or an apparel stock can suffer from, and this is a massive deceleration in revenue growth. Revenues used to grow 30%, it went down to 24, 18, 10%, 7%, 3%. It's expected to go negative in Q1 of 2026. Same thing with comp sales. They decelerated a lot. And this is the worst thing that can happen to a growth stock in general, and this is why it gets an aggressive repricing. Now, normally, whenever I have a retailer like Lululemon and other retailers reporting bad earnings, deceleration in growth, I want to figure out if this is a temporary problem or if this is a permanent problem. If it's a temporary problem, then it has likely to do with the economy being weak, and maybe that's why Lululemon is not doing so well, but maybe it also has to do with the brand of Lululemon deteriorating. Now, if I look at the mix of revenues on a geographical basis for Lululemon, United States revenue has been pretty much flat, and we know we don't have the best economy in the United States. Now, on the other hand, China's revenues have grown a little bit, but nothing too crazy. Other revenues have also grown, nothing too crazy. Canada's revenues has pretty much been flat, so there's very little change in general in terms of revenue growth for the company in different areas. Now, for me personally, I don't believe this is a problem with the economy. I think this is a problem with Lululemon itself. And I'm not the only one saying that. The CEO of Lululemon, he's saying it himself. He's saying we have become too predictable within our casual offerings and have missed opportunities to create new trends. Our lounge and social products offering have become stale and have not been resonating with the guest. He is 100% right, and that's why you're seeing more of Alo kind of pants and other kind of workout clothing and outfits and all these kind of things, because it's very tough to be in this industry. And that's why I don't like to invest in the apparel stocks in general, is because you cannot predict the consumer demand and consumer preferences. So let's say Lululemon is popular today. Tomorrow, some influencer goes viral on TikTok wearing some kind of new cool pants from China or wherever they're from. And then everyone wants to copy the influencer and everyone wants to copy each other's, and they all copy each other's. And this is how you have a new trend. And then Lululemon could be suffering, and it's not even the problem of Lululemon. It's not even their own mistake. It's just the consumer has changed their preference and they suddenly like something else. It's very hard to predict those things. But I do believe the CEO and the management have made a mistake. They have not been innovating. Their products have been the same for a while, and a lot of people are trying something new, and Lululemon is being left behind. And it's very hard to reverse the trend. But looking at the valuation, it's now trading at 15 times earnings, guys. 15 times earnings is dirt cheap for a company like Lululemon. It used to trade at 70 times. Now it's trading at 15 times. So I believe a lot of the bad in Lululemon is priced in, especially as the company is expected to return to growth in 2027, which is mainly late 2026, around 9% earnings per share growth and 10% the year after that. You're paying 15 times for that is really not bad at all. And the company, the management team have been taking advantage of that by buying back a lot of stock, reducing shares outstanding to create long-term value per share for a lot of shareholders. So I personally believe Lululemon is more than fairly priced over here. I believe a lot of the bad is likely priced in. I think there's more that could go right, that could go wrong. But if it was me personally, I would much rather pay 20 or 19 times for Meta where it's trading at right now versus paying 15 and a half times for Lululemon. Meta was trading at 19 times like 2 or 3 days ago, and Lululemon is at 15. There's many different opportunities way better than Lululemon, not as cyclical. So I believe Lululemon is fairly priced. I don't believe it's a generational buy. I don't believe it's a buy of the century. I think it's very attractive at 15 times, but I also believe there's way better opportunities in the market. And I believe the second stock that I'm going to talk about is a little bit better and much more attractive than Lululemon, in my opinion. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try it out, they give you 30% off right now if you use my link down in the description. Now, the other one that I really like very much personally is Shift4 Payments, ticker symbol 4. The stock is down 35% year to date. It's been doing really, really bad. But the interesting part about it is the insiders have loaded up a lot of shares at a much higher price, about $16 million, around $81 to $83 per share. And today the stock is sitting at about $71 per share. So if you're buying the stock today, you're paying about $11 less than what the insiders have paid. And it was not a small buy, around $82 or $83. To me, this is a very interesting setup in general. But Shift4 is a payment processor. You could say kind of like Fiserv. Fiserv has been a disaster. It's down 70% year to date, and it's dragging a lot of good companies with it, including Shift4 Payment. There's really bad sentiment around the payment processors in general, but I believe Shift4 is a very interesting one. They're number 2 in payment processing at the restaurants, right after Toast, I believe. The first one in hospitality in the United States, the first one in sports and entertainment in the United States. So you could say we have the World Cup tailwind, which is not priced in for 2026. Number 1 in luxury retail globally in terms of processing, which is huge. And this is mainly after the latest acquisition, which gives them a lot of exposure to luxury retailing in general. Now, again, this sell-off to me is very weird because if you look at the latest report, they grew revenues 29.5%. So revenue growth has reaccelerated in a major way. Earnings per share was negative 89 cents in 2021. Now it's positive $5.45, and it's expected to be 6.73 next year in 2026. So the company is doing everything right. Everything is improving, but the stock is going down. And it's really hard to find a reason why. Volumes are going up and gross profits are getting better, but the stock is just going down. But I believe there's one main reason why the stock could potentially be going down, other than the sentiment of Fiserv, which is bringing down a lot of stocks. I think there's another reason, and this reason is slower organic growth. So the way the company measures organic growth, I believe, is they use gross revenues less network fees. Okay, this quarter they grew 61% in terms of this metric. But if you exclude the latest acquisition, the growth was only 18%. And before this acquisition, Shift4 has been decelerating in revenue growth. It used to grow 34%, it decelerated to 25, 19, 16, then it has the acquisition and they jumped back to 29%. Now they were also decelerating due to a weaker economy, so luxury spending is not big now, right now. Sports in general is not too big, restaurants are slowing down, all the restaurant stocks are down 20, 30, 40, 50, even 70% year to date. So we don't have the best economy. It's waiting on the revenue growth of the company in general, but this is the thing with the payment processors. Even Fiserv does a lot of acquisitions because it's hard to grow organically in terms of a payment processing company. Because if you're processing payment, either you have to expand organically, which is hard because it's not easy to move payment processors from a business. So this is a very sticky revenue. So it's hard to do that. Unless the economy kind of expands and luxury retailing is booming and everything is booming, which is not the case right now, the best way to grow is through acquisitions and acquiring other payment processors that are already deeply integrated within different retailers. And to do that, you need some debt and you have to take on some risks. And maybe the analysts are saying that the company is highly dependent on acquisitions, and now they're doing well and they've been doing well. But will they be able to keep finding and integrating those acquisitions successfully? Maybe the analysts are not sure, and that's why the stock is going down. Now, in terms of the company in general, This is a $4.8 billion market cap. Enterprise value is $9.6 billion, almost double the market cap. So the company clearly has a lot of debt. In fact, the debt level has skyrocketed recently. They have $4 billion in long-term debt, about $700 million in current debt, and they have about $1.8 billion in cash and cash equivalent. Now, the debt for me personally is really not concerning because it's well spread out. For 2025, they have $700 million due. 2026, only $10 million. 2027, they have $642 million. And after 2027, it's well spread out. There's around $3.4 billion due. So there's nothing that's due anytime soon. And I'm not really concerned about it. The company still has $1.7 billion in cash for them to pay it off. And they can even potentially do more acquisitions and expand the revenues even more in terms of revenue growth. But free cash flow is also robust. It's very, very sticky, guys. $511 million for 2025. They're expected to put up $685 for 2026 and about $800 million for 2027. So I'm really not worried about the debt at all. I don't believe it's concerning, and I hope the company starts reducing shares outstanding very soon to create value for long-term investors. In fact, they did announce a $1 billion buyback program, which I believe is about like more than 20% of the market cap, around 20% of enterprise value actually. So this is a good buyback program, and it's going to help create value for shareholders. In terms of the valuation, it's trading at 11 times earnings. 11 times earnings is dirt cheap for a company like Shift4 with such sticky recurring revenue. Not recurring revenue, but you could say very sticky revenue stream in general, and they're deeply integrated. It's hard to move payment processors in general. So I believe 11.5 times earnings is undervalued for a company that has been growing earnings per share about 80% this year in 2025, expected to grow 23% 2026 and 20% for 2027. So I believe it's undervalued, and I like it, to be honest, much more than Lululemon. But if I really had to choose, I wouldn't even buy any of them, and I would be buying maybe Meta or Uber on the sell-off and many different stocks that are much more interesting than Shift4 in my opinion. But that was my opinion on the two Michael Burry stocks. If you want me to analyze Molina Healthcare and other stocks, please let me know down in the comment below. So thank you for watching. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.